like to maybe start with Alhaji Mohammed, if it's okay.
Thank you very much, moderator. I'm pleased to be here this morning on the invitation of the CFA Institute. Subject of discussion, very important to all of us, especially the young ones who are coming up, profession of banking and finance. Let me first start by defining confidence. Confidence is the belief or the feeling that you can have faith and trust in something or someone. Financial institutions, I can say, are not only banks and insurance companies. Financial institution has a wider, broader meaning, including firm of chartered accountants, stockbrokers, even some government institutions. Now, if we look at the system we're operating today, I can say clearly that confidence is getting weaker in the financial system today. The reason is not far too difficult to understand. Even though banking is the most regulated industry worldwide, the happenings since 2008, during the financial crisis, has worsened the confidence people have in financial institutions. Trust, as the President said when he was talking, is extremely important because we are talking about money, and we know what money means to human species. If you look at what is happening today, even after the 2008 crisis, so many other things happened. Banks collapsed. Many companies, corporate organizations in the US and UK collapsed. In fact, countries began to collapse. The case of Greece is very clear, and other countries which we have known to have suffered financial crisis. Now, why is it important to have trust and confidence? It is important because we are dealing with money. Anybody who wants to put money in anywhere or with anybody, he wants to make sure that his money or investments are safe. And that, I think, is what is bringing us here today. The role of ethics and incentive are also very important. If we look at ethics, you find that ethics is something which has been studied by philosophers over the centuries. Some people call them morals, others use the word terms interchangeably. I think I prefer to use them interchangeably, morals and ethics. Mm-hmm. Now, if we go back to the main subject of the matter, there is a disconnect between incentives and aspirations for ethical conduct. In a bank, for instance, where I worked for some years, it is important for management and board to be ethically correct so that they can show example to junior staff, where then the customers take a cue from there, have trust and confidence in the institution, and place their money and accept their advice. In many cases where problems arose in institutions like banking, you find that the issue really is one of confidence in the system. Confidence by customers, confidence by regulators, confidence by other stakeholders. It is important that Central Bank of Nigeria, which I'm familiar with, has been trying in the last 10 to 15 years to make sure that banking is done extremely well. The code of conduct for corporate governance has been addressed in the last few years, and I understand they have been making effort to change, give it greater focus and impetus. In this respect, I think perhaps in the next couple of years, we'll see more and more ethically correct institutions coming into Nigeria. The experience of Islamic finance is also something which I think we have to take care of. It has given the industry, financial service industry, examples of how ethical conduct can make organizations grow. They may not grow too fast. In fact, I always say steady and slowly, slow and steady wins the race. If you want to grow steady and slowly, then I think ethics is extremely important. Today in Nigeria, I think we are getting into that stage where banks and other financial institutions are becoming more and more conscious of the need to instill confidence in their staff, confidence in other stakeholders, and confidence in the regulators. Thank you very much.
Okay, thank you, sir. Oscar, we'll take a few comments from you.
Thank you very much, Ore. Let me start by thanking the CFA Institute for inviting me to participate in the discussions today. I think I'll be making my remarks from a capital market perspective and also from both a Nigerian and African perspective. As you know, we have an MOU that was signed with the CFA Institute between the African Securities Exchanges Association and the CFA Institute to jointly support candidates from the capital markets that want to take this certification. And the reason why we did that, indeed I signed that MOU with Paul in my capacity as the president of the African Securities Exchanges Association. And the reason why we did that is that we have so many shared values with the CFA Institute, including the issue of ethics and trust. You know, I like the theme of this year's conference here, measure up. And so we, as an industry, capital markets industry, have always looked at ourselves from the perspective of global best practices. And if you look at what is trending globally, you will see, even from a study that Alderman Trust conducted with institutional investors, that the most important thing for institutional investors when they make investments is actually trust, far higher than the performance of companies amongst their peers, far higher than the kinds of policies that companies have, their R&D and the rest of it. So it just goes to support, and this is a 2017 study, it just goes to support what exchanges have always known, that what we sell is trust. Our platforms, you must trust our platforms in order to participate either as an investor or as an issuer, you know, because like Sarkin said, we're dealing with money, and people must trust the platforms. And so some of the things that we've done now from a Nigerian perspective to build trust really has to do with transparency, clarity around the rules of the game, and enforcement. As you know, exchanges are like a hybrid, right? So we are operators of markets, but we're also self-regulatory organizations. So we do have some regulatory aspect to what we do. So enforcement is something that we really believe is important. For the Nigerian Stock Exchange, we've done a few things. We've introduced the corporate governance rating system. So just focusing on companies for a second, I'll talk about operators, you know, the sell side in a minute. We've introduced the corporate governance rating system, and this is a system whereby companies do a self-assessment. The directors take a fiduciary awareness exam to make sure that they understand their responsibilities as, you know, directors of companies. And then we bring an expert multi-stakeholder group, external group, to put some validity into the entire evaluation process. And companies are generally graded, if you score 70 and above, then you have a pass mark, and you're able to join the Corporate Governance Index, which we've created for companies. On the back of that, we introduced the Premium Board, which is a board for large corporates that hold themselves out as having the highest corporate governance standards. And there are institutional investors that are looking for such indices to track and to invest in. Another interesting thing is that when you look at institutions around the world, most of them are now beginning to adopt a code, a stewardship code, which mandates for them to get more involved in their investee companies, to go to shareholder meetings and vote, understand the issues and vote on behalf of their clients and such other expectations. So that is something I think we ought to be looking at in Nigeria from an institutional investor perspective, because it's very important for institutional investors to really hold their investee companies to account and not leave it to the much smaller shareholder associations that really don't have significant holdings in these companies. From some of the other things we've done at the exchange, we, in addition to the corporate governance rating system, have introduced a code, a status symbol code for companies, such that on the ticker tape, near real time, you can see the compliance level of each company that you're looking to invest in. That is very important because we think that investors ought to understand whether these companies are in compliance with the various rules when they make investments in these companies. Transparency, like I said, is very important. So even our rule book is now electronic and everybody can access it on the website. And there are so many other such transparency initiatives. I'm not going to bore you here with that. From an ethical perspective, we think it's very important that we place it in a proper context, right? So yes, we must benchmark with global standards, but we must also put it into the Nigerian context as we look to hold management and boards of companies to account. From a sell-side perspective, the exchange introduced minimum operating standards for the stock brokering community. It took a lot of effort, but I believe right now about 94% of the brokers have met those minimum operating standards, which include 5 dimensions really: strong corporate governance, technology, processes, competitiveness, and the like. So in wrapping up, I think I've taken some time. In wrapping up, for us, these issues are very important. We've taken some concrete steps, and we continue to take concrete steps. We think that in order to have confidence in the entire system, these steps are not enough. Policy needs to be such that it enables confidence, and incentives must be aligned in such a way that people that hold themselves out as having the highest standards, ethical and corporate governance and the rest of it, actually benefit financially from doing that. And that's why I was talking about situating ethics in our context, where people cut corners and are not held accountable. We have to do better than that. Thank you.
Okay. Thank you, Oscar. So, Andrew.
Good morning. I don't feel, sorry, I do feel sorry for Abu, who's going to come after all 3 speakers, because I find it very difficult to know what to add to what the previous 2 speakers have said, but I'll give it a shot. The first thing I think is that, and again, this has been alluded to, but I'll try and put some numbers on it. Ethics actually pays. I recently was looking at a study, I think it was done by the IFC, where they actually tried to quantify how much added value is given by markets to what are perceived to be well-governed companies. And they surveyed a number of markets. Sadly, Nigeria wasn't one of those markets. But if I recall correctly, depending on which market, the premium that investors said they were willing to give to well-governed companies ranged from about 15, 16% to up to 40%. And clearly, the more issues that countries had with governance, the higher that percentage would be. You can see this to some extent if you look at the Nigerian stock market, where companies that are sort of larger, well-governed, maybe with a strong shareholder that inspires confidence, tend to trade at much higher multiples than some of the other companies, although, I don't have any quantification of this. Now, in this example, governance, of course, is a proxy for ethics, because in my view, you can't have real good governance without, underlining that with a strong ethical position. You can tick all of the boxes in terms of meeting governance codes, but still have a poorly governed company. And again, without mentioning names, there are certain now defunct banks, for example, which are prime examples of that situation. So without a sort of ethical foundation, you can't have good governance. And good governance certainly inspires a lot of confidence in terms of investors. And again, one I think can extrapolate to other areas. Certainly, for me, I was introduced as a non-executive director of the CDC. As many of you know, I used to be the CEO of the Africa Finance Corporation. I was there for 10 years before I retired, or maybe they got bored of me and kicked me out earlier this summer. I think one of my greatest or proudest achievements at AFC, and which I'm pleased to say I worked with your CFA president on, and a number of the colleagues whom I even see in the room, was the credit rating that we were able to achieve. We were able to achieve the equivalent of an A- rating, which was the second highest credit rating of any financial institution in Africa, second only to the African Development Bank, and I can't resist saying it, about 6 notches above the credit rating of Nigeria itself. And how did we achieve this? First of all, we didn't achieve it overnight, and I think building up a reputation for good governance, for consistency, for transparency, etc., which are many of the things that underlay our ability to get that credit rating, took a lot of time, a lot of credibility, and also, and I think this is one of the things that maybe we don't say enough when we talk about governance and ethics, we had to make some difficult choices. We had to forego certain opportunities because they did not, sit well with the sort of organization we were trying to build, some of the things we were trying to achieve. So I think it's very important to point out that if you choose to follow a path of ethics, sometimes you have to make decisions that maybe, at least in the short term, and this is what I always say to people, do have certain costs. I think it's nice to think that taking the right path all the time doesn't cost you, but unfortunately sometimes it does. I would like to think that in the long term, as you're building up a reputation, as you're building up essentially social capital, that those costs that you incur in the short term actually bring bigger benefits in the longer term. In short, in a way, you're making an investment in sort of being an ethical organization. For me, I think how do you build ethics and trust and everything into an economy? I mean, the financial sector being part of an economy, and maybe as has been said by previous speakers, particularly dependent on trust and therefore ethics, but actually it's something that is much more widely applicable and has much wider utility. How do you build that? Firstly, and again, in a sort of developing society like this, demonstrating what good ethics, what good governance, etc. means, and showing people what this means from a very early age in their careers is important, because a lot of people, to be frank, maybe would like to do the right thing, but don't know what that right thing always is, especially, and if we can be frank, when a lot of the quote-unquote role models in this society often model, frankly, unethical or at least dubious behavior. So, you can't always follow the people who have been successful in this society and figure that that's really, helping you to build an ethical foundation. And where I'm coming to is I think that the efforts like what the CFA Society does, emphasizing ethics, proper behavior from very early on in people's careers, is very important in terms of building a culture, a cadre of people who understand and operate ethically. I think that people who are involved in investment analysis, preparing accounts, all these sort of nuts and bolts of making a financial system work are very important. Well, there are many CFAs in the audience. I'm not one. I don't have the privilege of being one. But as you would all know, what goes into accounts, even though they're hard numbers and everything, particularly when you're looking at complicated things like investments, is actually quite subjective. There are a lot of choices that go into it. There are a lot of assumptions. There are a lot of forward-looking things. And therefore, you as the analyst, you as the preparer of accounts, actually have a lot of power to either present very clearly or very falsely what companies are doing. And if people can't trust the numbers, the underlying numbers, then what can they trust? So I think that the CFA Society, the focus on ethics, instilling ethics from very early on in a professional career is one of the, frankly, several building blocks that we need in order to, improve the level of ethics, governance, and trust within our society. So I'll leave it there for now. Thank you.
So finally, Abu.
Well, I think Andrew has already ended it, so I will take the time I have on the mic to make a personal appeal to be admitted into the CFA Society. And I have a very strong reason for that. I think I'm probably the only person who ever sat in the office. To my left was the former president of the CFA Society, and to my right is the current one, and I think that is sufficient ground. I heard them. I think I know CFA now. Or if that is enough, I think I stop there. No? Or you insist I must say something?
I think earlier you need to say something.
I would give some other perspective. For me, I would like to start by refocusing attention on financial services and why I think it's substantially different from almost all other forms of commerce. Most commerce are based on transactions, so there is a very clear starting and ending point, and you go into the transaction and it's ended and you move on. and you can almost always change your counterparty with every transaction. But financial services is very much like the relationship you have with your government. You pay taxes until you die, whether you like it or not. Or in marriage, generally it's expected that you will stay put. Same thing with your financial service partner. So because of that, and especially in banking, I think money has a form that has very few comparable alternatives. And therefore, trust in financial services takes a very different dimension. But I don't like trust to be thought of as something that financial services do. I think of it in terms of what I call a tripod of trust, especially for banking. Three key players. I think the first player in the trust tripod is actually the customer first and foremost. Take banking, for instance. What are the two biggest risks that you run as a bank today? The first one is your credit risk, which expands these days to other forms of risk. And it is the risk that you can't trust your customer to pay back the money that you've given out. And on the second side, there is also the compliance risk, which is the risk that the customer you've taken on board is not a customer you should be banking. Take out those two risks and you de-risk financial institutions significantly, specifically banks. So the trust question must first start with the customer. And it's important that we figure out a way as a society to reduce the distrust that exists today between banking and the bank customers, because that creates the other issues. The second component of trust is the regulatory input into trust process. And that is because trust is not just about individual players in the market, but it's a systemic issue. Do you trust the system? Do you trust the system of where investment happens? Do you trust the banking system? And therefore, the regulator plays a far more important role, especially when you imagine that trust is not necessarily a concrete thing that you can measure, but largely a perception of what people think can or do happen, and it doesn't have to be the truth. That is an area where we would call on the regulator to continue to play an important role in creating that. But finally, the role of the banks and other financial institutions in trust. I'm not going to focus on the fact that trust is important. I think that humanity would not exist in its current form without commerce, and as has just been highlighted, there is no commerce without trust, so that is a given. But what do banks need to do to create trust? Why is it important? The first one is to change the concept of profit and the concept of value. I like the idea of connecting professionalism to purpose, and therefore trust to purpose. If you ask me, for the companies that fail, they are profitable 99.9% of their lifetime. So if you talk about profit, Lehman Brothers was profitable every single day until it was not. And if you look at that as a measure of profit, then you tend to think that profit is something you get at a point in time. But when you start to think of it in a different horizon, what does profit mean? That means you must then connect financial institution to purpose. And it's very difficult because, again, more often than not, when it comes to financial institutions, we only think of them in terms of balance sheet and in terms of profit. That is just the only measure we fall back to. And that needs to change. For me, I will go back into a few real-life examples. First of all, for banks, and I think it's also true for investment advisors, the most important thing you need to create trust is to create alignment. In other words, if you can align the interest of the professionals or the individuals who work in financial services with the society's interest for sustainable growth, then you can create a spectrum or motivation for people to focus on trust and ethics and to think of that horizon. In the absence of that, if you don't have that alignment, then what tends to happen is that people measure success by parameters that are not sustainable. So increasingly, it is measured by profit, by bonuses, and by how much you earn. Whereas what you really need is to measure success on a different horizon that says that it is important that you are sustainable, it is important that you care for the future generation. So coming back to Sterling Bank, where I work, because I think it's not, what I'm here to share with you is not the research that I can do. I suspect you probably are better at that than I am, but the experiences that I've had. So this is what we've done for alignment. every single employee that works for Sterling Bank today is a shareholder in Sterling Bank. Not just on a one-off basis you are a shareholder, but every month, as you receive your financial compensation on one side, you are also allotted more shares in the bank. So it's not just an interest, but it's one that is a growing stake in the bank. The objective was to find a way to reduce the gap between the interest of the stakeholder, the interest of the employee, and to some extent the interest of the regulator. Because we feel that the interest of the stakeholder, the shareholders of the bank and the regulators are highly aligned, to the extent that the regulator has the power to deny them of the ability to do business. So we wanted the employee to be equally aligned. And what that has done is that we see people care more about a longer horizon, because there is also a vesting period after you get those shares. The other thing we've done is how you treat bonuses and terminal benefits. So take, for instance, the terminal benefit for executives in Sterling Bank. 75% of it would be received in the equities of the bank, not in cash. That was an option that was given to executives, and they all signed up for it. But not only do you get your terminal benefit in equities of the bank, you can't, it is also vested for 6 months after you've left the company. So if I left the company today, I couldn't touch it or do anything with it for at least 6 months. Again, it comes down to what extent do I care about the worth or the value of Sterling Bank 5 years from now relative to the result in the next quarter. If I'm focused on the next quarter result, then it's likely that I focus on what gives immediate answer. To sum it up, why should why is it important for the Institute to care about trust in financial services? Obviously, the first one is the argument for commerce. If you have trust, you have commerce, the pace of engagement increases and you have more. The second one is to look at the issue of the economy. With a simple example, today, Nigeria Bank has no history of, the Nigerian as a sovereign has no history of default, but it pays at least 3 times as much as some countries that have defaulted before for Eurobond. Why is that? Because if you look to the past, we have a 100% record of repayment. Why do we pay 3 times as much? Because people don't trust that we will be able to pay in the future. And it's not just a question of will we be able to generate enough money to pay. It is about, do you trust us to take it seriously, to take our obligation seriously? So at the end of the day, because we pay 3 times as much, it means we can borrow 1/3 of what we'd ideally be able to borrow. And therefore, the question of infrastructure that we talked about earlier then comes to play. If I can't get the money to fund the infrastructure, then I can't grow the economy, and so we're in a vicious circle. Trust is the one way to unlock that value and to grow this economy. Thank you.
Okay, thank you to all the speakers. So we're just going to take a few questions, and Abu, I'll start from you so that you don't have to take the last question. You make it a little bit easier. One of the things you alluded to is that as a country, Nigeria pays more for its bonds issuances than it should. But how do we deal with that information asymmetry that is probably behind that? Because if it was clear that our future is bright, everything is rosy, no one would ask us to pay so much more.
So to be clear, there is information asymmetry, but also worse than that, I actually feel that the story we tell plays an important role. There are 2 stories to Nigeria. There is one Nigeria where we have difficulties and infrastructures are weak and we're struggling to fix that. But there's also another Nigeria where if you start to look at that story, what you see is a lot more positive. You start to think of the few sectors where we've seen significant growth, from entertainment to the telecom, to financial services, specifically to the pension reform. And then you look at the demographics, and you look at what is now happening with financial technology in certain areas. You can see 2 stories. Question is, what story are we telling? Rule number 1 is you must tell your own story. And I think events like these are a very powerful way of telling that story. So thank you to CFA Society for arranging this. The second one about the information asymmetry. Again, Oscar has spoken about the work that has been done by the capital market. And I think the central bank has done a lot of work in providing some transparency around how things are done. We now need the fiscal side to pay a lot more attention to storytelling, because at the end of the day, it's all about the stories that you tell. It's all about the information that you put out. And hopefully that is beginning to happen. I mean, the Nigerian Investment Promotion Council, for instance, has done a lot of work in the last year to push a positive story, and we're seeing some results.
Okay, thank you. Andrew, one of the things you mentioned about AFC was how you were able to get your A- credit rating and how you forgo certain opportunities at a point in time to get there. Nigeria is a place where we know that every quarter you're trying to report good numbers. How do we convince, ourselves that those opportunities that are further down the road are likely to be bigger than the ones we have to forgo today? Because when you look at a company or a person who has to try and report on a quarterly basis, it's a behavioral change, but it also has to be from the organizational shift. I know you were able to get that done in AFC. Maybe you can tell us how you were able to convince your board that that was the right thing to do and that the greater good that would come from looking more longer term rather than looking at the immediate was better for the organization.
That's a very difficult question. And, there are many layers to the response. I'll give one example. It doesn't actually really relate to the board, but, we were talking to the rating agencies, and we knew we were going to get a rating at some point, and we had to do that. But we started engaging with the rating agencies probably 3 years before we actually got the rating. And I remember, one time we met a rating agency and they said, oh, well, so we told them what we were about, we told them what we were planning to do. And they said, well, why don't you just get a rating now? And we said, well, look, we could get a rating now, but we think that you will trust us better if we wait for a couple of years. We meet you every year, we say, this is what we're going to do next year, and we actually do it. Or we come somewhere close. And then at that point, after 3 years of this, then, when you come and sit down for the rating, and we say, okay, these are our plans, this is what we intend to do, you'll give that some degree of credibility. Whereas if we do it now, we'll tell you something, you'll apply a huge discount to it, because you haven't really had time to build up trust. I think that this says a few things. I mean, one, it says that these things don't happen overnight. And as I said in my introductory remarks, there's a certain degree of quote-unquote investment that has to go into this. You have to put an effort in, and it takes some time for that effort to come out. And that applies to companies. So companies that are listed, they have to report quarterly. They always complain about this and how the analysts are, too short-term. And there's a lot of truth in that, it has to be said. But on the other hand, I think that, the companies themselves need to realize that they also need to build up trust with the analysts. I think if a company has a long track record of being very open and honest and, delivering, and they come with, one bad quarter of results, and they say, look, guys, this is what happened, this is why we think it will improve, etc., the market is likely to give them, some benefit of the doubt. On the other hand, if they do that once and then the next quarter is bad and the following quarter is bad, then, you come for the fourth quarter and people are like, guys, what are you talking about? So, that's on the one hand. On the other hand, I think also analysts also need to look at a longer term view as well. Many companies are growing. AFC, luckily, we were very lucky in AFC that not being listed, we only had to report once a year. I can assure you we had certain quarters where we had, pretty awful looking results, but, over the course of a year, they kind of evened out. So analysts also need, when reviewing these things, need to be sophisticated enough to figure out, what is like a temporary, or normal up and down. As we all know, results don't go in a straight line up and to the right. There's a lot of volatility in them. So, need to try and distinguish better what are the long-term trends and what are the short-term volatilities. I mean, of course, the really exceptional analysts are the ones who are telling their clients to buy when everyone else is selling. And maybe that's the advantage that you as an analyst would get on the other side of that equation by taking a longer-term view.
Thank you, Andrew. Turning to Oscar, the retail investor. We've talked a lot about institutions. How do we get the retail investor to come back into our market and really trust us? I think Alhaji Mohammed alluded to the 2008 financial crisis and how everything just seemed to fall apart. And I think in Nigeria, we're still seeing the retail investor still not sure. You've mentioned certain things that the exchange is doing. How well are we communicating that information? What else should we be doing?
This is a very challenging area for us, I must say. And the reason is that I think the 2008 financial crisis in Nigeria, a lot of us may have forgotten, but if I were to dimension it, the market lost about 70% of its value. And that was the first time the market took that kind of dive. So for us, I characterize it as our own Great Depression, if you were to compare it with the US. And the US markets took over 10 years to recover from the 1929 crash, depression. So a number of things have to happen. It can't be one thing in order to bring back that confidence that the retail investors have. The first is that we must be very honest with ourselves. The capital markets and the investments you make in the capital markets don't always go north. They sometimes go north, sometimes go south, depending on what's going on in the business cycle and in the economy and in the operating companies that we've invested in. A lot of the investors, retail investors, went into these stocks believing that it was one way, and therefore took an inordinate amount of risk in investing even their children's school fees into the market. So that's one. So a lot of education, investor education, needs to go on to help people understand that there is risk and there will be volatility in the markets depending on what's going on. The second thing is what we talked about earlier, the need to actually have strong institutions that are sustainable, right? So from a company perspective, not just ticking the box like Andrew was talking about, but actually living it. And that's why that corporate governance rating system that I talked about is so important for us. In fact, if you look at the premium board companies, which are companies that have all passed the corporate governance rating system, and are large size companies, they tend to outperform the market. So the premium board index, that premium is about 12%. Premium board index outperforms the all-share index all the time in an up market or in a down market. It doesn't matter, it outperforms. And that is consistent with empirical studies around the world. So there's actually a reward for doing things the right way. Yeah? The last piece to it, we think, is that we're in an age of the fourth industrial revolution, where you have new technologies and new business models that allow for people to better understand the customers and to better access the customers. And we must take advantage of these technologies. So using big data analytics and things like that to really understand these retail customers and what they really want is very important. And then finding new ways to reach them. There are a lot more Nigerians that are carrying cell phones now than ever before. How do we access them in a way that allows them to achieve their saving and investment objectives using some of the tools that we have out there? And there's a lot of work going on there, including some of the work we're doing with the mutual funds and other collective investment schemes.
Thank you. Finally, Alhaji, some of the studies have shown that trust seems to erode over time. And I'd like to maybe get some insights from you. What can be done to ensure that the person who came in and, you're supposed to be the trusted advisor, who trusted you, as you said, it's supposed to be a marriage, something that's for the long term. How do we ensure that that trust remains consistent?
Right. First, trust, I think, should be mutual. In banking, customers come into a bank trusting that their funds will be safe. Banks also trust their customers that they will continue to patronize them, so the relationship is for the benefit of the two parties. Now, for a bank to make sure their customers trust them, they have to be open. In other words, the figures they bring out must be true and the only truth. Oscar's place, they go and tell them, they call them facts behind the figures. These facts should be real facts and not fiction. In many instances, in the past 20, 30 years in the Nigerian system, we regrettably now discovered that a lot of the information being put forward was really not really correct information. So for now, I think if we are to get into a position of trust, it is important that the banks and other financial institutions must connect with their customers, be open and tell them the truth. I remember in the 1990s when banks began to fail, the then managing director of the NDIC quoted one instance where he said, bank failure can be systemic. In other words, if one bank fails, another one is likely to follow. And I think we've seen that. And the question of too big to fail has also been demystified. So I think what I'll say, Ore, is that it is important for customers to trust their banks. It is, but more important for the banks to trust their customers. Since, as I think it was Andrew who said, that sometimes you find it difficult to distinguish between one and the other.
Okay, thank you. So now I think we have time for a couple of questions from the audience. Okay, so we have 3 questions. We'll try to run through them. Okay, so I think the first one is for Abu. Please, can you discuss how share allotment to employees has improved the ethical stances of the organization?
Okay, thanks for that. I can start with myself as an employee. Maybe that's a good place to start, and how it has changed my horizon. I think the first thing is that you want to change people's perspective from the monthly performance, the quarterly performance, which are useful, but can very easily be distorted for short-term gain. So the most important thing is that at the most senior level, at the C-suite, at the executive level, there is an understanding that the real reward for our work is going to come from the success of the bank, not what we receive monthly. And I think that that is important. The second one is if I look at the rest of the employee, especially the junior workforce, I am convinced that as the percentage of their savings or their net worth, it's increasing as the shares in Sterling Bank relative to other saving form, they start to take the institution more seriously and they start to worry more about the long-term success. Unfortunately, I don't have any data that I can quote right now, but I feel very confident that the level of commitment that I have from the employees to the survival and sustainability of the institution is more long-term than it used to be. But the other angle to that is also to add that we also tried to connect the employees to a purpose. So beyond just making profit, we have as an institution built around a narrative that says that we're here to enrich lives, and we've tried to make sure that is applicable to every stakeholder. And we've even moved further to create a strategy that is built around things that are bigger than just the bank. We have something called the Heart of Sterling, which says that, look, these are the 5 sectors where we're going to make sure we have a major impact. And there are sectors that individually people connect with very easily. So it is health, education, agriculture, renewable energy, and transport. So I think the point is that you can't just do one. You can do the equity stake, but you must also have an institutional narrative that gives people a long-term view that can then mean that they're thinking not just of what they get today, but what the institution will become tomorrow.
Okay. Thank you for that. So I think we've actually run out of time, but maybe we'll just take one quick question, and this is for anyone on the panel to pick up. There's a question about where do we see the economy in the next 5 years? So who has a good crystal ball?
I'm willing to give it a go.
Sure.
First of all, I'm an optimist, so please go discount it with whatever method you want to use. But the comment I made to my colleague before we came on board is that Nigeria is inevitable. So it is not one of those things that is optional, whether it's going to happen or not going to happen. Nigeria as a strong economic force is inevitable. The outcome in 5 years is a question of how big is it going to be, or how easy is going to be the path to success. And it's because we tend to tell the Nigerian story by focusing on government. We should tell the Nigerian story by focusing on what is happening outside government, because that is where the change is going to come from. I see that change. I'll give you the best example. Power is seen as a must-have for the economy to move forward. And our narrative before is that you need $100 billion worth of investment in power to get started. That narrative is wrong. We now have what is essentially a distributed model where renewable energy, specifically solar, is now cheaper than most ways of generating. So while we're still trying to resolve within government, the reality is that power is going to be reformed in Nigeria in the next 2 to 3 years. It's going to get to the point where industries would provide their own power and to be competitive. So Nigeria in the next 5 years, I tell you, it's going to be by far Africa's largest economy. It is going to be anywhere between, my view, $4,000 to $6,000 per capita income, and I'll be in retirement. Thank you.
Thank you. On that note, I'd like to say thank you to all our panelists, and thank you, everyone, for listening.